And thank you for joining us for today's live call, Weathering the Coronavirus Market Downturn. My name is Darcy O'Brien, and I'm the Chief Marketing Officer at Simon Quick, and I will be moderating today's discussion. Our goal in hosting this call is to help you capitalize on the changes we've seen in global financial markets. We also hope to address any of those financial concerns that may be keeping you up at night. So please don't be shy and use the Q&A function on Zoom to submit your questions. You may also submit questions by emailing me at dobrian@simonquickadvisors.com. I'd also like to mention that there is a visual component to this call, so if you have access to a screen, go ahead and click on the Zoom link, which will allow you to see my video and some slides with useful information. Before we dive into the questions, I have a few housekeeping items to mention. The first is that we are going to stop hosting these live calls on a bi-weekly basis. When we first began hosting these calls, the markets were in what seemed to be a free fall, and so we felt that it was important to host these calls regularly in order to address our clients' concerns. However, in recent weeks, as we have seen some recovery in the markets, we're going to pull back from doing these sorts of updates on a regular basis. That being said, if the situation changes, we can always schedule additional calls, and of course, we remain available to answer any of your questions on an individual basis. So please do continue to reach out in the future. I'd also like to mention that this call is being recorded and will be posted to our website and circulated over email tomorrow. And now for a few disclaimers. This presentation is for information and discussion purposes only. Please remember that past performance may not be indicative of future results, and there is no guarantee that the concepts and ideas discussed during the presentation will be profitable or prove successful. Now, let's introduce our panelists. Today we have with us our Chief Investment Officer and Managing Partner, Chris Moore.
Hi, Darcy.
Hi, Chris. Thanks for joining us. We also have our Head of Investment Research, Wayne Yee.
Hey, Darcy.
Hi, Wayne. And lastly, we have our Head of Financial Planning, Bill Layler.
Hi, Darcy.
Great to have you, Bill. So I'm going to start with the questions we've received over email, and then we'll dive into the queue and respond to questions in the order in which they were received. First question comes in from Raj. I've been thinking about going to cash given the recent run-up. Do we still think there is sufficient risk reward with equities to maintain an equities at target weight?
This is Chris. I could take that one. In short, the answer is yes, we do. We do believe there is still an attractive risk reward in equities to maintain a target weight. I would highlight that we are still defensive within equities, though. And what I mean by that is we continue to favor higher quality companies with more exposure towards large cap domestic stocks, specifically sectors like technology and healthcare. So we do continue to believe that is an attractive place to be within equities and think the risk reward on a going forward basis is there. I might just highlight, with the rally, it does feel like stocks have moved incredibly fast and significantly higher than where they were at the trough. But if you were to consider a roughly kind of 35% decline, if my math is correct, you would need a 50% rally to get back to where you were. Markets are still down on the year, and using the S&P as kind of a proxy doesn't really do kind of the rest of the global equity market much justice. And I mean that because the S&P is down about 8% or so on the year, but there's a handful of large cap tech stocks, Google, Facebook, Amazon, Netflix, that make up 20% of the index because it's a market cap weighted index. And if you look at the equally weighted S&P index, it's down closer to 18% on the year. Additionally, European stock index is down 22. The Russell 2000, which is a measure of small cap U.S. stocks, down 21. Emerging markets down 17. So the point I'm trying to make is global equities are still down on the year, and in many cases down significantly. The rally we've experienced is in the market cap weighted S&P index led by growth stocks, which many have believed to be, including us, the place to be coming out of this pandemic. So we're of the view that maintaining equity exposure at a target weight makes sense here for the ability to kind of capture growth in stock appreciation, not saying that there won't be volatility. There could easily be volatility between now and the end of the year. I think we've said before, we're surprised we haven't seen it thus far. I certainly would have thought a 10 or 15% decline in markets along the way in this rally would have been likely. We just haven't seen it yet. And the economic data is going to be bad. It's going to continue to be bad for a couple of quarters. And, that could certainly create more volatility for stocks. But, we do think there is a tailwind here that the market has experienced over the last couple of weeks associated with favorable monetary policy, fiscal policy, and very heavy stimulus. So we're cautious about equities, which is why we're target weight, but defensive within our exposure.
Thank you, Chris. Our next question comes from Kelly. How common is it for clients to carry balances on a margin account? Do you think it is a good idea to make a practice of using margin as a source of investment capital?
This is Chris. I could take that one too. We don't use margin as a source of investment capital where we're basically leveraging long exposure to take more, equity or fixed income risk. Where we do use margin is we use it to maintain cash flow, whatever cash flow needs our clients may have, whether that's associated with operating expense needs or capital calls for some of their illiquid investments, be it private equity or distressed or venture or real estate. Margin rates are sub 2% right now, so it's a very attractive time to be using margin. But we do not use it to the point where we're saying, let's get your equity exposure above 100%, where we're actually long stocks and then borrowing against those stocks to increase your equity exposure. We generally do it across equity and fixed income exposure and do it to meet any short-term cash flow needs. It's generally not a kind of year or multi-year strategy that we're going to suggest implementing.
Great, thank you, Chris. Our next question is from Jessica. How would the firm's fixed income allocations change if negative rates became a more likely possibility in the U.S.?
This is Wayne, and I love fixed income questions, so I'll take that one. Powell spoke recently and made comments that while negative rates are not a likely near-term option, he did say that there were significant tools still at the ready for the Fed to use if the markets or economy were to continue to deteriorate. So in that vein, and thinking about where Europe and Japan are with negative rates, like the risk, or let's call it the potential of negative rates, is possible in the U.S. It's within the realm of possibility. Having said that, how are we positioned? We have continued to move higher in the credit quality kind of spectrum. And that wasn't even a March effect. That really kind of started late last year, or the second half of last year, and just continued on during this time. And that part of the portfolio have been pretty protective here. What we've been seeing over the past, let's call it 2 months or so, is that fixed income managers have been taking on more credit risk, so less interest rate sensitivity and more credit sensitivity. Still staying at the top of the kind of credit quality spectrum, but taking more of it to express their fixed income kind of exposure. So just more spread, more return. So from that perspective, even if interest rates were to go negative, within the realm of reason that it's not severely negative, your credit spread component will still give you a positive effect or positive interest income. additionally, the move from kind of very low rates to negative rates will still cause a pull, a tightening in the yield curve, which will also create a capital gains element or a total return opportunity within fixed income instruments as well. So we would say that we're postured to be conservative. We're not looking to be heroes within fixed income because it's meant to be more protective and more steady. But I would say that there has been a move into taking a little bit more duration, but a little bit more credit risk to generate some return in fixed income right now. So negative rates, as it happens, will be beneficial in that moment, but at that point in time, after we're now in a negative rate environment, that's what we'll have to really kind of think through, like where else do we reposition the portfolio, because you definitely don't want to be paying money on top of inflation, or I guess no inflation right now, but you want to pay on top, pay out on holding any instruments.
Thank you, Wayne. The next question comes from Paul. Why would you want to go into active equity managers at this point when the passive ETFs have been the best performers? When will active managers start to add value?
Yeah, this is Wayne again, and I guess as a person that's trying to kind of pilot the research effort here, it's something that we think a lot and constantly, in the sense that we still take the view that your first kind of investment decision should be based on the asset allocation rather than just trying to find the right manager. Like the asset allocation across fixed income or equities or alternative opportunities, those should be the first decisions made, and then thereafter the passive versus active conversation comes up. And I would say broadly, because markets have gotten very efficient, notably in exchange traded or kind of liquid asset classes, that the beta or the passive element of kind of returns generation has been pretty convincing. But we're not looking for your generic or kind of run-of-the-mill manager that would be a coin flip in any year whether or not they generate excess returns. What we're looking for are managers on the active side that, while yes, we want them to be high performing, but we want to make sure that there's a process and structure around that gives us consistency and the ability to stick with a manager through periods of volatility, where the S&P can have, let's call it a 15% type volatility number around it. So that's the cost of risk for owning a passive index. If we can get something that looks like the S&P or generate an S&P type return, but can do it in a more risk-controlled fashion, like that's value right there from an active manager. So maybe your return looks exactly the same, but the amount of risk you took actually is lower via a potential active manager than not. So the unicorn there is that you find someone that outperforms the benchmark and does it in a more risk-controlled fashion, and that's what we seek to attain, and that's why kind of understanding managers' processes and controls and kind of risk frameworks are important. But in that vein, looking at the growth equity space, like just owning QQQ or owning Russell 1000 growth, like you could do well from there, or from that perspective. But we agnostically look for active managers that can still outperform and be persistently outperforming over cycles, over multiple years. And in that very selective process, we will pick one or two managers that can be active and still generate strong returns. And that's what we seek to do in creating portfolios.
Great, thank you, Wayne. We have a couple more questions in the queue. So for those of you on the line, if you are sitting on a question, now would be a great time to go ahead and submit that on the Q&A function. Our next question is from Colleen. What impact could the upcoming election have on estate planning?
Hey, Darcy, it's Bill. I'll take this one. The upcoming election could definitely impact estate planning. In 2017, the current administration passed the Tax Cuts and Jobs Act. This act significantly increased estate, gift, and generation skipping tax exemptions for U.S. taxpayers. The current exemption amount is over $11.5 million for an individual, You double that for a couple. And it's adjusted annually for inflation. This act also kept the step up in basis and portability provisions. Step up in basis eliminates gains on assets when transferred at death. And portability allows the transfer of a deceased spouse's unused exclusion amount to the surviving spouse. Both these provisions are very beneficial in estate planning. And currently the estate tax rate tops off at about 40%. Under these current laws, the higher exemption amounts are going to sunset in 2025. And so starting in 2026, the exemption amounts will return to $5 million, adjusted for inflation, which at that time will be between $6 and $7 million. However, with the change of an administration and possible control of the Senate, added on top of it today's political climate, changes to any of all of these provisions could be on the table. Recently we saw in Joe Biden's tax plan, he proposed taxing unrealized appreciation on the assets past the death. Effectively, this eliminates the step up in basis at death. Step up in basis is an important estate planning tool, and its loss would significantly impact a lot of planning that's been done today. We encourage everyone to take advantage of the current tax laws this year and consider making gifts if you're going to be impacted by any changes. Now's the time to make outright gifts at the current exemption amounts. You also have the added benefit of depressed asset prices. I would add it's very unlikely that anything done this year would not be grandfathered in under new tax if the administration were to change. Back to you, Darcy.
Thank you, Bill. Our next question comes from Keith. Is now a good time to refinance my mortgage? When the Fed has set interest rates to 0, it feels like mortgage rates should be lower.
I'll take that one too, Darcy.
Okay.
Mortgage rates are, if you look at them historically, they're at lows. Earlier, before this crisis, they were at rates probably a little lower than they are now, which is leading a lot of people to feel like, maybe the rates are going to trend low over time, where they should be lower. But the truth is, mortgage rates are not really tied to a specific index. They're really set by supply and demand. Most mortgages written today are sold to Fannie Mae or Freddie Mac, where they're bundled into mortgage-backed securities and sold to investors. And the rates in these securities have to be high enough to incentivize investors so that the banks can sell the loans. Then the banks can get the money back again and lend it out to another mortgage buyer. For some of the larger non-conforming jumbo loans, some of those banks do hold those loans on their book. However, from what we're hearing, these banks aren't interested in writing long-term loans for much lower than today's rates. So I think the answer is yes. If it makes economic sense to you, now that is the good time to refinance, because it's really hard to tell if rates are going to go any lower, and they could just easily trend up higher. Thanks, Darcy.
Great, thank you, Bill. Our next question comes from Vicky. What do you recommend if you have lost your healthcare coverage due to this crisis?
Well, okay, I'll take this one too, Darcy. Thanks. For most individuals, the answer is going to be COBRA. If you've lost your healthcare coverage, COBRA allows employees and the families to have access to their employer's group health coverage should they be. You're able to purchase the same health coverage you had for you and your family for up to 18 months. And after you lose your job, there's a special enrollment period that's open for 60 days. Although coverage through COBRA is not perfect, it can be expensive. Costs can be up to 102% of the full annual cost. Most employers only pay a portion of the employee's cost. So by going on COBRA, you could be responsible for the employee portion, the employer portion, and there's even a 2% charge that could be added on top of that. However, I mean, this may seem like a lot, but you're still getting group rates. So it's still probably going to be cheaper than going out to the marketplace and trying to get, you know, an individual policy. Also, an added benefit is you are able to keep your current network of doctors and healthcare providers. Unfortunately, you know, COBRA, the option is only available if the company and health plan are still in existence. If a company were to go bankrupt and shut down the plan, COBRA is not going to be available. And if that happens, then you are going to be forced to go out to the marketplace, which is very state dependent. And at that point, you know, I recommend you look up your local state's health exchange or go on healthcare.gov to see what options are available in your state.
Thank you, Bill. Our next question comes in from Casey, and he asks, where are we seeing opportunity in this environment?
This is Wayne. I could talk a little bit about that. And not to be too self-serving, but there is significantly more opportunity today than there were just a few months ago. If you kind of think about where we were postured, we were underweight equities at that time. We were unexcited about credit, kind of broad generic credit at that time. We were leaning more into alternatives. We still like alternatives, but that's just kind of one element. And to some of the earlier questions about going to cash, I think going to cash now, I think it's kind of too late to just be in cash. Now, if people were unexcited about equities or had now gotten to an overweight position, there are opportunities to rotate. And the opportunity set has been really opened up to kind of really provide a lot of different ideas and ways of generating returns based on kind of risk appetite, risk tolerance, and kind of the tenor or the length of your investment horizon. And I kind of frame that as there's dislocation opportunities, there's distressed opportunities, and there's just longer term alternatives or private equity opportunities. Dislocation opportunities, there are high quality assets that just because maybe there was a structural inefficiency or immediate liquidity need that caused high quality assets to sell off. Like these are high quality, very low default risk assets that sold off dramatically because just the investor or the individual that held the asset had to sell it because they needed to raise cash. That opportunity is short term. It won't last for a long time, but there will be, but there are opportunities to make kind of high quality risk adjusted returns in that over the course of the next few quarters. Low double digits, mid double digits, let's call it something around that area, but with a very low kind of downside expectation there. Then distressed companies are going to go through restructuring. Like we saw the stock market rip back a lot or come back a lot, but the economy is still trying to figure itself out in the sense that the stock market's trying to predict what's going to happen in the future, whether that be at end of 2020 or end of 2021 or 2022. But the economy in itself, for those businesses that need to pay interest payments, meet mortgage payments, have salaries, or just seeing kind of fall offs in revenues, those companies will have to go through a restructuring process. Now, they're probably good businesses. There are a mix of good businesses and bad businesses. Bad businesses will get impaired much more dramatically. But there are good businesses that just need liquidity help for a 2-quarter type period just to get to a more normalized kind of operating environment. And that's another opportunity. So those don't require heavy restructuring, but will require some liquidity infusion. Then businesses that need to be equitized, like that's another opportunity where you're making multiples of your money, but it'll probably take 5-10 years to fully realize that return potential. So that's coming from like short term to medium term. And in the long term, I mean, there are those distressed restructurings as well as private equity. Private equity exposures today, the sponsors are looking through their portfolios and saying what companies need to restructure in a more active way. But then there are also, whether it's in venture capital, growth equity, or in buyout, those that have capital that have not yet deployed, this is going to be a dramatic opportunity for them to put money to work and generate significant returns through this vintage. So they'll be able to buy kind of somewhat riskier businesses, but have the opportunity to kind of generate significant returns because valuations are finally falling more within reason, particularly in the middle market, smaller cap space. So I think that's pretty interesting, and it does create an opportunity. And really, I think it just allows for greater engagement with clients and individuals to say, what is your risk tolerance? What is your appetite? How much liquidity do you need? We can build something around that because there's more to do and there's more optionality out there.
Thank you, Wayne. The next question comes from Scott. Following up on the election estate planning question, what is your view of how the market is pricing in, if at all, the possibility of a Trump win or a Biden win?
This is Chris. I could take that one. I think at the moment, despite kind of Trump's lower approval ratings, the market is likely pricing in a Trump victory at this point. The market doesn't like surprises, so if Biden was to win in the fall, the market would certainly have to digest the potential for a reduction in corporate tax rates, and potentially some tightening of regulations across corporate America. The truth is, with all of the kind of COVID activity, the administration has certainly made plenty of mistakes along the way, but it's been, without kind of debates, in-person debates or rallies, and Trump really getting kind of a lot of the television time, the market is certainly acting as if, there's going to be a Trump victory in the fall. And I think as we've seen over the last couple of weeks here, markets have just skyrocketed higher without really any downside volatility. That could certainly change as we head into the fall and there's more activity on the election front. But at this point, I'm of the view personally that the market is not assigning a high probability to a Biden victory.
Thank you, Chris. Our next question comes in from James. Does Simon Quick plan to reopen its office in Morristown anytime soon? What would reopening look like?
This is Chris. I could take that one. Good question. We have a subgroup of folks that are actually tasked with kind of coming up with the process for reopening and how we envision doing it and over what period of time. We have not come to a final decision yet, but I feel comfortable saying we're not going to be opening the office anytime soon or mandating that employees be in the office anytime soon. When we get to the point at which we feel comfortable having folks come back into the office, it will be staggered. It will be with all of kind of the social distancing efforts enforced. We want to create an environment for the team where everyone feels like they have kind of maximum flexibility and that their health and safety is the highest of concerns. And we want to be certainly thoughtful as we think through the reopening, but we also have the luxury that throughout this period, our business has been able to perform and respond quite well working from home. Everyone has been unbelievable throughout the last, I guess it's 10 weeks now, using Zoom and Microsoft Teams and getting everything done that they've been getting done in a very kind of efficient and effective way. So with that in mind and seeing how effective we've been, management feels comfortable that, we could take this slow and steady.
Thank you, Chris. Next question also comes from James. What is the impact of companies rethinking use of office space on opportunity zone investing?
That's a good question. And maybe I'll kind of expand that into kind of real estate broadly, where the prior question I addressed in the opportunity that's in front of us across kind of corporate entities. Real estate is going to be, there's still a big unknown there. Because if we think about real estate, kind of lockdowns and shutdown procedures didn't really happen until very late March, and people were still paying their rent for the most part, for the vast majority of it, for the end of March to kind of pay for April. And then now April and May and go forward. Now that's where the biggest concerns are, where what is rent collection going to look like. And real estate is going to have to, and I'm speaking very broadly, real estate is going to have to figure out how to manage kind of liquidity needs balanced with the shortfall in rent collections without wanting to just push out tenants, because it's hard to just kind of refill a space versus maintaining a tenant. But you still have mortgage requirements on top of that, where a traditional big building will have anywhere between 60 and 75, 80% of debt on top of it. So there is more more scrutiny around the appropriateness of kind of real estate today. Now, obviously, lenders are working with real estate sponsors, but kind of hotels are going to be highly transformed. Venues are going to be highly transformed. Office space, same thing. We will not be at full capacity in any kind of short term, and the floor plans will look a lot different. So, kind of saying all that, multifamily seems to be doing pretty well. Logistics and industrials is doing really well, because I'm pretty sure everyone's been ordering a lot more from Amazon and what have you. But hotels are under significant pressure. Car parks or parking garages, another element that you don't really think about. Like, that's under significant pressure too, because if no one's driving or there hasn't been enough foot traffic, then there's been no rent collections at all. So that's another element of pressure that we're seeing out there. So yeah, I think investors will have to be very choosy in terms of what is the right asset and what are kind of break evens there, and kind of what's the viability over the long term. Now, obviously there will be kind of lender concessions and kind of renegotiations there, but that won't happen for all of them. So there will be some distress opportunities in that vein as well. That being said, given that the question is around opportunity zones is a really new concept that has really only started taking off last year. So we're in 2020, so 2019 is that's where you saw the most amount of kind of opportunity or investing or initial deployment has come in. The benefit on that front is that because of the tax elements and the tax treatment that you need to get to make sure that you got the full benefit of the OZ investment kind of structure, you wanted to buy cheaply, you were buying land or teardowns and looking to build assets that would be resilient for a decade, essentially. So from that perspective, lots of these properties are still very early stages in kind of whether it's drafting or starting to dig the hole. So there is the ability to rework some of those assets. Now, some places construction slowed down. Some places maybe construction, if it hasn't yet started, is going to be reworked. And that will potentially eat into your IRR a little bit. But because these are meant to be 10-year plus assets, the economy will recover, and that back end will still create a lot of opportunity. And technically, real estate is an inflation hedge as well. So for those that are concerned about kind of the inflationary effects, like the real estate will be a benefit there, particularly if you're building ground up and can adapt to the go forward environment. Now, some of the OZ properties that some of our underlying investments have partaken in, there's some multifamily in there, there's some industrial in there, there is one hotel that's being reworked in there. So we're early enough that nothing has been fully stabilized or ready to go, that the flexibility is what's going to be the benefit to OZ investments specifically. But real estate broadly will be a heightened area of focus of dislocation and potential opportunity in the coming quarters.
All right. At this time, there are no remaining questions in the queue. I would like to thank everyone on the line for taking some time out of their day to participate in today's call. Thank you, Chris.
Thank you, Darcy.
Thanks, Wayne.
Thanks, Darcy.
And thank you, Bill. Hold on. Oh, we got a thanks on the line. Thank you. One of our participants just sent a message, wanted to make sure I wasn't missing a question. Thanks, Bill.
Thanks, Darcy. Thanks,
If you have any additional questions that we were not able to address during the call, please do not hesitate to send them to me at dobrien@simonquickadvisors.com, and we would be happy to address them offline. Thanks again for joining us, and have a great evening.